You ever open your banking app and just stare at it for a second? Like, not even because you're broke. Maybe there's something in there. Maybe you've been trying to save. Maybe you've even told yourself, okay, this is the year I get serious about investing. But then you open YouTube, or Google, or Reddit, and suddenly you're hit with everything. Top 10. Stocks to buy right now. Dividend strategy for passive income. Crypto is the future. No wait, real estate is the future. Wait, iStocks are the future. And you just sit there thinking, am I supposed to understand all of this? Because honestly, it feels like you need a finance degree, 12 monitors, and a personality that enjoys spreadsheets just to get started. And somewhere in the middle of all that noise, you kind of freeze. You don't invest. You don't move. You just wait. And weirdly, that feels safer. My name is Tiam, and I spend way too much time thinking about money, like not just how to make it, but how people think about it. Why it feels so complicated, and why something that should be simple somehow turns into this overwhelming mess that most people avoid completely. And here's the strange part. What if I told you that building a solid long-term investment portfolio doesn't require dozens of stocks, or constant monitoring, or even being particularly smart about markets? What if honestly you could do it with just 3 funds? Not 300. Not 3 strategies. 3, and not in a gimmicky way. Not in a get-rich-quick way, but in a way that's actually been quietly working for decades. Today, I want to walk you through that idea. Not just what the 3 funds are, but why they work, why simplicity is so powerful, and why, if you let it, this could completely change how you think about investing. Let's be honest for a second. Investing doesn't feel simple. It feels like a world full of jargony TFS. Index funds, expense ratios, diversification, asset allocation. And even if you understand some of those words, it still feels like you're missing something. Like there's some hidden layer that real investors know about. And that feeling? That quiet suspicion that you're not doing enough or don't know enough? That's actually one of the biggest reasons people never start. But here's the thing, it doesn't get talked about enough. The financial world benefits from complexity. Think about it. If investing were truly simple, like just buy a few broad funds and hold them, then a lot of industries built around managing money would suddenly feel less necessary. And I'm not saying there's anything wrong with financial advisors or active management in every case, but for the average person, complexity often becomes a barrier, not a benefit. I remember when I first started looking into investing, I had like 17 tabs open, each one contradicting the other. One said diversification is key. Another said concentration builds wealth. One said avoid risk. Another said embrace volatility. And after an hour of reading, I felt less confident than when I started. That's when something clicked. Maybe the goal isn't to understand everything. Maybe the goal is to understand what actually matters. And that's where the idea of the 3 fund portfolio comes in. There's this subtle pressure when you start investing. It's not always obvious, but it's there. The pressure to outperform, to pick the right stocks, to time the market, to somehow be better than average. But here's a question that changes everything. Why is average suddenly a bad thing? Because in investing, average doesn't mean mediocre. It means the entire market, all the companies, all the growth, all the innovation, all the global economic expansion over time. When you invest in the whole market, you're not betting on one company winning. You're betting on the idea that, over time, human progress continues, that businesses grow, that economies expand, that the world moves forward, and historically, that's been a pretty solid bet. Now sure, there are ups and downs, sometimes big ones. Markets crash, headlines get scary, people panic, but zoom out far enough, and the trend is clear up. Not in a straight line, but consistently over time. So instead of asking, how do I beat the market? The smarter question becomes, how do I own the market? And that's exactly what the three-fund portfolio is designed to do. All right? Let's get into the first piece of this. The backbone, the core, the thing that does most of the heavy lifting. A total stock market fund. Now, that sounds fancy, but it's actually very simple. Instead of buying shares in one company like Apple or Tesla, you're buying tiny pieces of thousands of companies all at once. Big companies, small companies, tech, healthcare, manufacturing, everything. It's like owning a slice of the entire economy. And here's why that matters. When you invest in individual stocks, you're making a specific bet. This company will succeed, but companies can fail. They can make bad decisions. They can lose relevance. They can get disrupted. But when you own the whole market, you don't need to guess the winners, because the winners naturally rise to the top of the index over time. It's kind of like planting a forest instead of trying to pick the single best tree. Some trees won't make it. Others will grow massive, but overall, the forest thrives. Personally, this was the point where investing finally clicked for me. I stopped feeling like I had to constantly check news or make decisions. I wasn't trying to be smarter than the market. I was just participating in it. And that shift, it's incredibly freeing. Now, here's where things get interesting, because if the first fund covers your home market like US stocks or whatever country you're investing in, the second fund expands your view. An international stock fund, basically. This gives you exposure to companies outside your home country, Europe, Asia, emerging markets. And at first, you might think, why do I need that? Isn't my country's market enough? And that's a fair question, but here's the thing. No single country dominates forever. There are periods where one market outperforms others. And then it shifts. Different economies grow at different times for different reasons. So by investing internationally, you're spreading your bets across the entire world. You're not relying on one country's economy to carry your future. You're saying, I don't know which region will lead over the next 20 or 30 years, so I'll own all of them. There's something quietly powerful about that. It removes the need to predict and replaces it with coverage. I remember hesitating on this. At first it felt unnecessary, complicated, but then I thought about it like this. If your entire financial future depended on one country, would that feel comfortable? Or would you rather have a stake in the global economy? Once you frame it that way, it's hard to ignore. All right, this one's not flashy. It's not exciting. No one brags about it at dinner. A bond fund, and I get it. This is usually where people tune out because bonds sound boring, but boring is kind of the point. Here's what bonds do. They provide stability. While stocks can swing up and down, sometimes dramatically, bonds tend to be much more steady. They don't usually grow as fast, but they also don't crash as hard. Think of them like the shock absorbers in your portfolio. When the stock market hits a rough patch, bonds help soften the impact. And that matters more than people realize. Because investing isn't just about returns, it's about behavior. If your portfolio drops 40% and you panic and sell, you lock in those losses. But if your portfolio is balanced stiff, the swings feel manageable. You're much more likely to stay invested. And staying invested is where the real magic happens. So yeah, bonds aren't exciting, but they're useful. And honestly, the longer you invest, the more you start to appreciate that. So now you've got the pieces. Stocks in your home country, stocks around the world, and bonds for stability. And the beauty of this setup is how simple it is. You're covering growth stocks, global exposure, international, stability bonds, all with just 3 funds. No constant buying and selling, no guessing which sector will explode next, no late-night stress checking. Stock prices, just a quiet, steady system. And the best part? It scales. Whether you're investing $50 a month or $5,000. The structure stays the same. It doesn't get more complicated as you grow. It just grows. Here's the part that might disappoint some. People, there's no hack here, no shortcut, no. A secret trick that turns $1,000 into $1 million. Overnight, the real advantage of a simple portfolio is that it helps you stay consistent. Because consistency is where the real results come from. Investing regularly, staying invested during downturns, letting time do its thing, that's it. And I know, it doesn't sound exciting, but that's because real wealth building usually isn't. It's slow, it's quiet, it's almost boring, but it works. And honestly, boring that works is better than exciting that doesn't. Let's talk about what usually goes wrong, because this is important. People chase trends. They buy what's hot. They panic when things drop. They sell low and buy high without realizing it, and they constantly feel like they need to do something. Adjust, optimize, react. But every time you tinker with your portfolio, you introduce more opportunities to make mistakes. The three-fund approach avoids a lot of that because it removes unnecessary decisions. It creates structure. It gives you a plan before emotions take over, and that's huge. Because when markets get volatile and land, they will. You don't want to be figuring things out in the moment. You want to already know what you're doing. So let's bring this back to you. Not theory, not charts, not financial jargon, just your life, your goals, your future. Maybe you want financial independence. Maybe you just want to stop stressing about money. Maybe you want options, freedom, flexibility, whatever it is. Investing is a tool to get there, and the simpler the tool, the more likely you are to actually use it. That's the real power of this. Approach it lowers the barrier. It makes starting easier, and starting is everything. Okay, imagine this. You've set up your three-fund portfolio. You're feeling good, responsible even. You're investing regularly, maybe every month. And then one day, the market drops. Not a tiny dip, not a meh, it'll recover kind of day. I'm talking headlines everywhere. Read numbers. Panic. Your portfolio is down 10%, then 20%, maybe even more. And suddenly, all that calm, rational thinking you had, it starts to wobble. You open your app more often. You check the news. You start wondering, should I do something? And this is the moment where everything you've built is tested. Because logically, markets go up and down, but emotionally, it feels like you're losing money in real time. I remember the first time I experienced a real market drop. I thought I was prepared. I had read the books. I understood the theory. But watching your investments shrink, that hits different. And this is exactly why the three-fund portfolio is structured the way it is, not just for growth, but for survivability, because here's what's happening behind the scenes. Your stock funds are dropping, yes, but your bond fund, it's holding steadier. It might even go up slightly. And that creates a kind of balance, a psychological buffer. Instead of feeling like everything is collapsing, you see that part of your portfolio is still stable. And that stability can be the difference between staying invested or panic selling at the worst possible time. And here's the hard truth. Most people don't fail at investing because they picked the wrong assets. They fail because they couldn't stay in the game long enough. So when people say, this strategy is simple, they sometimes miss the deeper point. It's not just simple to understand, it's simple to stick with, and that's what actually matters. Now here's something that feels almost too simple to be powerful. Rebalancing, basically over time. Your three funds won't stay perfectly balanced. If stocks do really well, they'll start to take up a bigger percentage of your portfolio. If bonds lag behind, they'll shrink in proportion. So every once in a while, maybe once or twice a year, adjust things back. You sell a little of what's grown you, buy a little of what hasn't, and that's it. But here's why this matters. It forces you to do something that's incredibly difficult emotionally. Sell high and buy low, without overthinking it, without trying to time the market, without guessing. You're just following a structure. And over time, this adds a subtle but powerful edge, because instead of chasing performance, like most people do, you're naturally leaning against it. When something becomes overpriced, you trim it. When something becomes undervalued, you add to it. It's almost like a built-in discipline system. And honestly, most people don't need more intelligence when it comes to investing. They need more discipline. And this quietly solves for that. Asterisk. So if we step back and look at everything we've talked about, this isn't really just about 3 funds. It's about a different way of thinking. A shift from complexity to clarity. From prediction to participation. From constant action to patient consistency. And yeah, I know, it might not feel exciting. It might not give you that rush of picking the next big thing, but it gives you something else. Something more sustainable. A system you can live with. A strategy you can stick to, even when things get uncertain. And that matters more than almost anything else. Because at the end of the day, your financial future isn't built in one big moment. It's built in small, repeated decisions. Month after month. Year after year. And the simpler those decisions are, the more likely you are to keep making them. So if you've been overthinking this, if you've been waiting for the perfect strategy, if you've been stuck in that loop of learning but not doing, maybe this is your permission to simplify, to stop trying to optimize everything, and just start building something that works. 3 funds. A simple structure, a long-term mindset, and a willingness to stay the course. That's it. Not flashy, not complicated, but quietly, incredibly effective. And years from now, when things have grown, when your portfolio looks completely different from where it started, you probably won't remember the exact moment you began, but you'll be glad you did.